in the last 24 hours, we did decide to officially change some of the Pyreswap shows into other time slots. I will be making an announcement about those changes possibly tomorrow. So please stand by. There are going to be a few days that shift time slots, and this is being done to kind of cater to a larger and more international user base, if that makes sense. So for Theoretics Thursday, which is what we're going to do today, I'm going to get into the habit of doing Theoretics Thursday. By the way, today I'm wearing a R.L. Stein's Goosebumps shirt, in case you guys wanted to know. In order to get into the habit of Theoretics Thursday, which will actually be at a different time later in the day, at least later in the day for North America, I will be talking today about options. I'll be talking today about options, and the reason I'm talking about options is because I think that a lot of people have an idea of what an option is, and that is kind of whether they learned about options from Wall Street Bets or whether they learned about being an options trader from a more, I guess, conventional trading platform like Robinhood or Schwab or something like that. We're going to talk today about the concept of an option. And Pyreswap is meant to be, again, a evolutionary milestone in DeFi. And on Tuesday of this week, we recently sponsored we recently sponsored AVAX Talk. And I hope, again, thank you to all who attended and retweeted that. On the AVAX Talk, there was a lot of discussion about the way options could be implemented in DeFi. And I've been thinking about this a lot in my spare time, and perhaps I have some, we'll say, early stage ideas about its implementation, and I might be able to get into that later in this show. But in the meanwhile, I'm going to start off a bit educationally, and we're going to talk about what the concept of an option is, starting with the concept of a derivative. So I'm just going to do a check real quick. Yep, I do see that we are live on Twitter, and I see that we are live on Discord, and this computer we can worry about later for screen sharing. And what I'm going to do next is I'm going to bring in the whiteboard, and I'm going to bring it into frame here, ideally without any glare on it. So let's see if that works. So I think if I position it just like this, I think that's perfect. Okay, and nobody complains about the angle because it's better to have an angle than to have glare of one of these gigantic lights. Okay, fantastic. So the first thing I think that needs to be taught is the concept of a derivative, okay? Who here in my audience so far has heard the word derivative, and who here thinks they could define it in a single sentence? And when I mean a derivative, I mean derivative as it applies to financial instruments specifically. Okay. Well, I'm not seeing a stampede of people waiting to raise their hand, so to speak. So I'll basically explain it. There are two types of financial instruments, and they come in two types. One of them is called an underlying, and the other one is called a derivative. And the way that you can conceptually understand what an underlying is and what a derivative is that an underlying is something from which a derivative is derived from. So an underlying is, I guess you could say, the most essential or most fundamental thing that we have turned into an instrument. A derivative is an instrument that uses the underlying as its frame of reference, as its perhaps core ingredient. I think that's the best way that I can allegorize the definition. An option, then the two most common types of derivative that people know about are called options, and B is futures. Options and futures. I'm going to verify with my glasses here how this looks on camera. Okay, underlying, derivative, options, and futures. Can everybody read this? Is anyone having trouble reading this? Yes, leverage. And in order to understand what these are, Zero, and I'm of course responding to certain chats. If you don't see what chat I'm responding to, it's very likely the Discord general chat. By all means, if you would like a higher degree of interaction and engagement with me, you guys are all welcome and invited to join our Discord server. By the way, I should mention that the Pyreswap show is proudly sponsored by PocketScan, a gateway for Pocket Network. Okay, so underlyings and derivatives, and options and futures. And if you understand what options and futures are, there are two different types of risk configurations as it pertains to an underlying asset, equity, or instrument. And we're going to talk about underlying derivatives like we're talking about stocks. So if we're talking about an underlying, we could talk about like NVIDIA, right? We're going to talk about NVIDIA as an underlying instrument. For those of you who don't know, NVIDIA is a technology company that specifically specializes in graphics cards and GPUs, and now is a I think $3 trillion market cap based off of the AI boom. And a derivative would be a option or a future of NVIDIA. I'm hoping that makes sense. Yeah, so an option of NVIDIA itself. So NVIDIA's stock performance in the last 12 months, or even the last 24 or the last 10 years, arguably, has been quite explosive. And people who were already bullish on NVIDIA's performance, they were willing to take a larger degree of risk on NVIDIA's performance by, in fact, positioning themselves in a call option for NVIDIA. Okay, I'm hoping this is clear to everybody. So, before I keep going into this, I'm going to talk about what options and futures are and how they apply to derivatives. Now, what an option, you can also have options on things that aren't stock equities. You can have options on things like commodities. You can have options on things like real estate contracts. And we actually also have options in Pyreswap. They're just not conventional options that most people are familiar with trading. We in fact have something called the meeting utility. Mead is in fact a convertibility option, which we created as a utility for up to 9 different tokens. We have in fact increased the value, the economic and financial value of tokens based on the fact that they now have a options contract baked into the way they're perceived. You can have instruments embedded into other instruments, which again, this is I guess a more advanced level, but I'm going to start off by talking about it in the most vanilla way possible, and that's a double entendre. And let me just say good morning to everybody who's in my audience early. So yeah, good morning, Dr. Mac. Good morning, Zonic. Good morning, Zero Kex. Good morning, Look As. Good morning, I guess Fexer and Hyundai as well. Yes, good morning, good morning, good morning. Good morning, Pega. Good morning, Mr. Good Project. Okay, fantastic. So I'm going to keep going on options and futures. Now, when we talk about options and futures, these are agreements. A financial instrument is always an agreement, okay? Not to get too ideological, but there is a very important reason that these decentralized snippets of code that get deployed on blockchains like Ethereum and other smart chains are called smart contracts, because they highlight the fact that these pieces of code, these sets of instructions, are actually meant to function with counterparties. They're actually meant to function with counterparties. They're not just the idea of a program. They're meant to actually be decentralized. There is a reason behind calling them smart contracts, especially because of the encrypted aspect. So when we talk about options and futures, these are 2 different types of risk and 2 different types of reward. Now, an option represents a right. Let me actually erase this and rewrite it. And a future represents an obligation. So if you wanted to know which one is considered to be higher risk, a future is considered to be higher risk than options. So options are arguably a bit more degen than regular equities, and when you start trading futures, that is considered even higher risk than options. I hope that makes sense. When you buy a future, that is an obligation to make this purchase, whereas an option just represents the right to make a transaction. I guess you can also have futures in both directions, but a future represents the obligation, and an option represents a right. So options generally also have they have the ability to not be exercised. So the concept of an option, it has exercising rights, and it also has things like expiry. But an option represents a right that can be exercised. You can exercise a right. An example of this would also be the way that you can exercise Miranda rights when you get arrested. So when you get arrested, they tell you that you have the right to remain silent, which means you can exercise that right by remaining silent, or you can not exercise that right by, I guess, running your mouth. I hope that allegory rings true with a lot of you guys. But yes, options represent a right and future represents an obligation. But we're going to talk about options because options tend to be a bit more well-known among people who trade. And I'm going to explain perhaps what I think are some of the fundamental differences between options, how they're configured in conventional finance versus how they would probably have to be configured in DeFi. So I'm going to erase this now. Does anybody have any questions about me explaining that options represent a right and a future represents an obligation? Does anyone have any questions, or does anyone not understand? This typical difference? Obviously, like when you buy a future, you're buying the obligation to make a transaction. When you buy an option, you're buying the right to make a transaction. And the right and the obligation, this is a derivative instrument of something else. And the derivative is a agreement about a transaction on something that can normally be transacted in. Normally what you're doing is you are creating a purchase or something that can be traded that represents a future transaction. Both options and futures represent something in the future, but a future represents an obligation where an option represents a right. Okay, I'm assuming that we have no questions. I do have some notifications here. I will, of course, read questions out loud. And I do not see any critical ones. Let me verify that I don't have here in the chat. Or anyways, if someone is asking questions that I don't see, please, somebody else, if you're watching, please post it in the Discord general chat, which is very easy for me to monitor. We are going to be upgrading our streaming package to be able to route all channels into something that pops up on screen for the stream. That is a work in progress, and we thank you in advance for your patience. I'm on camera 2 here? Oh, camera 1? Okay, fantastic. Okay, so I'm gonna erase future represents an obligation, option represents a right. So the most important thing, and I'm actually going to read a bit from a textbook. For those of you who don't know this book, this is called Options, Futures, and Other Derivatives by John C. Hall. This is a very famous textbook for people who are in finance. And right here on page 31, they, in fact, in the intro chapter, they talk a little bit about options, okay? So options are traded both on exchanges and OTC, blah, 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 blah. There's a couple things you need to understand. A call option and a put option. Does anyone here know what a call option is and what a put option is and what are their main differences, based, perhaps, extrapolated on the explanations given before? What's that? Got it. Yeah, for sure. Okay. Well, anyways, I'm gonna ask anyway. Yeah. I'm not gonna not ask. There you go. Thank you, Pega. Option to buy. O-T buy. And in contrast, put is an option to sell. O-T sell. And when you're buying the right, when you're buying the obligation, basically what you're implying is that when you buy a call option, you are buying the right to buy an underlying instrument in the future. And you can in fact exercise this option when that option would be profitable. When you are buying a put, you are buying the option, the right to sell an underlying instrument, equity, commodity, etc. in the future. So when this is profitable, you can also exercise that option. Because options are higher risk for the person issuing them, they also have other contingencies like limitations. And that limitation is normally expiry. Expiry, also known as expiration. And this is a time limit or the window you have the ability to exercise the option. Because there's always something called the time value of money. So the person issuing these options, they hedge their risk against you by putting limitations on your ability to do this. There are also dozens and dozens of exotic options. In fact, you could find one of them inside Pyreswap today. But exotic options are a conversation for they are a topic for another time because I don't think people understand basic options. So we will start with that. Okay. Does everyone understand expiry? I don't think I need to beat that to death. Okay. So going on here, you have the ability with an option to make a buy or a sell transaction before a certain date for a certain price. Now, the price in the contract is known as the strike price or the exercise price. Okay, so when you buy an option, you get to when you purchase a call option, and you have like let's say you have a call option to buy Bitcoin at like 50,000. Right? If you have a call option to buy Bitcoin at 50,000, and you have to pay for a couple things. Now, the first thing you have to pay for is the option contract itself, which has its own costs associated with it. Because when you buy an option, you're not buying Bitcoin itself; you're buying the option to buy Bitcoin. And then, if let's say Bitcoin moves to 60,000, you can then exercise that option for effectively the margin of what would be in the middle as your direct profit minus the premium which you paid for purchasing the options in the first place. And I'm going to diagram that on the board. I know that was a bunch to drop off. And I'm going to explain how that actually can be implemented. Although I'll also explain some difficulties in that implementation and probably why you haven't seen a lot of it yet. There are two types of options that are like pretty vanilla, which are American and European. I'm not really going to... American options can be exercised at any time up to the expiry. European options can only be done on the expiry itself. That does involve like a little bit of the difference in prediction. American options arguably have a little less risk. European options have a little bit more risk for the trader, as it were. Okay, so yeah, it should be emphasized that an option gives the holder the right to do something. The holder does not have to exercise this right. This is what distinguishes options from forwards and futures, which where the holder is obligated to buy or sell underlying asset. Okay, so I hope everyone now understands what the obligation of an offset is, okay? So they have something called the strike price or the exercise price. Expiry is also known as maturity, but I'm also going to get into the concept of like how options are priced, and that is something called I'm not going to get into the modeling of it, but I'm going to explain that the options itself have their own underlying equations for pricing. But we're not going to get into that now. We're just going to get more conceptually into what that kind of looks like. So you have four participants in an options market. Generally speaking, if we're talking about options, you have call buyers, you have call sellers, and then you have put buyers and put sellers. And the most important part about having these four different actors is this provides in the interim market making for options. This is what I think will be a point of difficulty in DeFi and Web3 because organizing people who want to take the opposite position is something that is extremely difficult in conventional finance, especially when you're I guess you would say just getting an options market off the ground. And the fact of the matter is that without these counterparties, the market maker itself has to be the complete provider of all the liquidity. And I'm going to explain why in Web3 and DeFi, the implementation of options, how they would be true options and not bucket shop options, and what I kind of expect to see with this implementation. So first off, before I keep going, does anyone have any questions so far on options? And do you guys think you have a general conceptual understanding of what options are? Because I'm going to now... And this is one of those questions that I expect silence because either everybody understands or nobody wants to be the guy who admits they don't understand. Does that make sense? I hope one day we can all live without ego. I hope one day nobody feels like this ever. Okay, moving on. So When you, let's say when you buy a NVIDIA stock option, we're going to talk about one scenario where I'm going to explain why in a ledger economy, because by the way, Web3 is a ledger economy. I'm going to explain why ledger economies have a bit more friction in the implementation of options contracts than the conventional economy. And I'm going to explain why. So when you buy, let's say you have a NVIDIA call, right? We're going to do a scenario here, an NVIDIA call. And actually, let me just pull up on the internet. I'm going to, in fact, pull up I'm going to pull up an NVIDIA chart here just like maybe a weekly. Oh, yeah, I could do that. Yeah, good point. Yeah. Why am I not doing that? Okay, I will be pulling this up on screen share, actually. And let's go to... Okay, this is actually what, the one day? Okay, let me actually get out of the browser and let me go to... let's see if TradingView wants to do it without hitting me up with pop-ups. Okay. NVIDIA, okay, it's in a downtrend, but most things are. And I'm going to change, let's first turn it into candlesticks. Let's do a full chart as well. And we'll also make it the 1 month. And yeah, fantastic. Okay. What, are you right here? Gotcha. Okay. Yeah, so this is actually pretty fine. Okay, I could actually move the chart a little over to the left. Yeah, like this. All right, let's see. Perfect. Okay. And yeah, that other part you don't need to see. But we can look at this right here and we can see, let me actually crunch this down as well. Okay, looks pretty much the same. Okay, so you can see that up here about 30 days ago, NVIDIA was at $131. 30 days ago would have been what, July 8th or so? Yeah, July 12th. At $131, okay? And now we have here at August 8th, we're trading at $98 or $99, okay? So NVIDIA has lost roughly a quarter of its market cap in the last 30 days. That's so goddamn degen. Holy shit, that's so degen. That's so crazy. I'm glad we're talking about NVIDIA. Yeah, you don't see that too much in conventional finance. That's crazy as fuck, man. Anyways, yeah, that's like $750 billion in a month. You know what I mean? It's a lot. It's not. I'm not laughing. I'm just, again, this is gonna make a great little case study. Anyways, so if you had a, let's say an NVIDIA call and you bought it on July 12th at $131, and let's say you bought the option to buy, you had your call, buy NVIDIA at $131, right? This option right now will be doing terribly. Does that make sense? Let's assume you have like a 100-day expiry. You've now lost a quarter of the market cap right here. Does that make sense? I would imagine most people are bailed out of this option completely, and I think the fact that this is this option is not profitable is not going to be. I think it's more conceptual if I can do a more profitable one. But okay, let's assume that you're buying at $131, and let's say you don't know. How about this? Let's say that you're actually bullish at buying at $99. Let me use this. Let's say you want to buy at $99. Let's say you're buying one today, and you think that at September 8th, I'm going to draw some other color. You think it's going to be back at $120. Does that make sense? So literally, a call at buying NVIDIA at 99. We're going to change this to 99. This will make a little bit more sense. Let's say you're like, you know what? I think that the market sucks right now, but I think this is the bottom. So therefore, buying NVIDIA at $99. Now the first thing you do, this $99 here, this is your strike. So let me label this stuff. and you're also going to have a position on the amount of shares. So this is your strike price, and you're going to be paying a price for the option and how many shares are included in that option. So let's say that you're buying, they call option to buy 100 NVIDIA shares. So we'll actually do that. 100 NVIDIA shares at $99. Now, NVIDIA times $199, let's see. What's 100 times 99? Is that near $10,000? Okay, but you're not going to actually be paying $10,000. Does that make sense? You will not, in fact, be handing the broker $10,000 to get in this position. Does that make sense? You're going to buy the price for the option because you're not buying the equity when you buy 100 calls of NVIDIA at $99. You're not buying the equity, you're buying the option. Now, the option has a derivative price. I'm not going to... there are literally I think 12 the multivariable equation for options modeling is so crazy. I cannot do it in a single hour or even during the Pyreswap show ever. But the fact of the matter is, you're going to be buying a fraction of a price. And for the sake of this, we're going to say you're buying it at 5% of what that price would be. Does that make sense? You're going to put down 5% of that. So for about 10 grand, because we're talking about $100 times 100, we're gonna turn that into 5%. So 10% of 100 grand, 10% of 10 grand is 1,000. So let's say that 5% is 500 bucks. Okay, so we're gonna say that the option price is $5 per option. We're gonna say the fucking the option price equals $5, and then you multiply that by 100, and this equals $500. So it costs you $500 to get into position for this option. Okay, so when you're holding an option, if you're holding 100 calls of NVIDIA at $99 because you think that in a month or sometime in the next 100 days it's going to be 120, and you're going to in fact not just make a 20% gain, but we can actually look at this. You're going to make if $99 times 100, if it goes to 120, we can actually do the math on the total amount of profit that you can make. $99 times 120, that would be a 20% gain. But you bought this for $500 and you bought it at you bought it to exercise a buy at 99 and then a sell at 120. So if you're going to buy 100 of these, you bought 500 bucks of them. Sorry if I'm getting jibbered. Sorry if I'm. Okay, we're done. If you want to buy NVIDIA 100 of these at $99, you bought the right to buy $99, and then once the price touches 120, you could immediately sell it as well if you exercise the margin. So 99 shares at 100, that would be $9,900. Does that make sense? This is literally the position you bought the right for, and then the amount to exit would be $12,000. Does that make sense? So the difference between here would be $2,100. Does that make sense? So when you're talking about buying the right to this, when you're holding with $500, the $500 that you paid, the value of this exercise is now going to go up exponentially. Because from this $500, does that make sense? You can immediately triple your money from this profit margin. Does that make sense? So instead of you just getting 20% profit, you can actually get, 200% profit. Does that make sense to you guys? Because if you bought 99 and got to 12,000 and sold this, you'd be making about 20% profit. But as soon as the exercise of this is now worth that margin, this option is going to become what the margin is worth minus the cost of entry. Does that make sense? So this $500 is now going to be worth about 1,500 bucks. Does that make sense? So this $500, I'm going to use, which marker? I have too many of the same color here. This 500 could now be worth $1,500. Does that make sense? So literally from 20% of positive price action, you can in fact triple your money in about 1 month if you think that's going to happen. Does that make sense? A 20% gain can turn into you making a 200% gain through the power of options. Have I lost anybody so far? Have I lost anybody? And look, I got a pop-up over here. Yeah, I'm sorry. Oh, it's hitting me up. It's hitting me up for a fucking... Yeah, I gotta go to Yahoo Finance. And this is actually not bad. Let me just change it to 1 month. Okay, that's fine. Yep, looks like the same type of data. All right, fantastic. Okay, so I have it on Yahoo. Next time we want to screen share, and not really important. But anyways, does anybody understand or misunderstand or have any questions about what we're talking about why options are arguably lucrative? The night statue is blocking the whiteboard slightly. I do see that. Let me move the whiteboard there. Perfect. Yep, no glare. Can everyone still see it? Let me see if I'll just pivot. Yeah, perfect. Okay. I appreciate that feedback. Fantastic, fantastic. And we definitely are getting a larger viewpoint. So does everyone understand that you can, in fact, through the power of options, through the power of derivatives, this $500 will literally become worth $1,500 because the profit you would be making to be able to buy at $9,900 and $12,000, you secured that for the entry of $500. That is a binary option, Maddie. That is a binary option, which is a type. Okay, for those of you who are not on Discord, Maddie asks, is this the product where you bet price is higher or lower after a certain amount of time? That is a binary, meaning you're just buying on whether it's higher or lower. Does that make sense? They call it binary, meaning it's higher or lower. That is a type of option, and those options, I guess, are very easy to understand. But I'm focusing more on the general concept of an option like a call or a put, because I think that this was, by the way, this was based on a conversation that happened on AVAX Talk on Tuesday. So for those of you who aren't aware, Pyreswap is now a proud sponsor of AVAX Talk every Tuesday, and we were discussing the implementation of derivatives in Web3, DeFi, crypto, whatever you want to call it. So I'm going to explain, though. First of all, everybody here understands that the $500 option now became a $1,500 option because in order to exercise, by the way, you don't get this $500 back. So this is one of the reasons that the broker is able to issue options, because they always collect this part of the fee. So this $500 does not become $2,000; it becomes $1,500. Does that make sense to you guys? Well, yeah, Pega, what he's describing is a binary option, which arguably is a betting game. Like, it is the most casino-fi type of option. It's a call option is the right to buy. A call option is the right to buy at a strike price of $99, and as soon as the underlying, meaning NVIDIA stock, as soon as the underlying trends upward, you have reserved the right to buy 100 shares of that based on the premium that you pay to the broker or the market maker or the exchange. So a call represents an option to buy, and a put represents an option to sell. We're talking about an NVIDIA call for the sake of discussing the concept. NVIDIA right now is at $99. It has in fact lost a quarter of its market cap in the last 30 days. So we're implying that you could buy, in theory, if you wanted to buy a call option on NVIDIA right now at $99, and you wanted to be bullish enough that it would be worth more because NVIDIA stock would recover within the time before expiry. So expiry, also known as maturation or maturity, that is the window of time that you have available to exercise the option, at least in American options. Yes, so an option gives you the right to make the purchase, but it doesn't actually make the purchase. I hope that makes sense. I hope that answered everyone's questions there about options. European options, the difference is that they're a little bit higher risk. You can only exercise them at maturity. Yeah, so American options, you have the entire 100 days to exercise. European options, you can only exercise them on day 100. This has to do with the time value of money. For those of you who don't know, the incantation Witch Vault is inspired a little bit about the idea of a European option having moneyness at the end of a period. Does that make sense? So instead of us doing a 100-day cycle, we do a 6-hour cycle. So every single piece of Pyre Phantom, Pyre AVAX, or Pyre BNB, they are in the money in the last second of every 6-hour epoch, right? How much money they are in depends on how the DEX has performed in the last 6 hours. So To be clear, we use options theory a lot in the design of Pyreswap. The incantation Witchfall, active staking, is based around the concept of moneyness. There's also something called a volatility smile, which I guess I can screen share that as well. Let me pull up a volatility smile. I'll put this up on screen share. And for those of you who can see, just above my head on screen share, let me put on my glasses. Just above my head on screen share, you can see that the volatility smile implies the implied volatility, which means implied means the future volatility. It's like what you can expect the pattern to be. The volatility smile, that type of curve, represents how an option price behaves based on whether or not it is in the money, meaning it's profitable, or out of the money, meaning unprofitable. The concept of moneyness is something that is applies to derivatives, and that means whether or not they are profitable or unprofitable derivatives. So if you've ever heard of us talking about the velvet rope pattern on Pyreswap, the velvet rope pattern is an implied sequence of volatility smiles, because we put every single player in the exact same European option, and it's an option for yield, by the way. Yes, it's not an option to sell, it's an option to fucking collect dividend. It's a great instrument. You know, when you release, I'm sorry. I don't want to sound like I'm shilling. I don't want to sound like I'm sucking my own dick on a camera, but it's fucking phenomenal. Yeah, DeFi doesn't deserve it. I can't believe I have to work this hard to convince people how great it is. But anyways, fucking A. I'm just kidding, everybody. I appreciate you all. The point being here, I hope everyone now understands what a call option is. You are in fact acquiring purchasing rights for an underlying equity that you can exercise at a later date. The later date you can exercise it on is determined by the terms of the options contract, which can be variable based on whether you're doing this on Pyreswap or in the European market or the American market or through an OTC market or any other fucking thing. There are other real estate contracts called lease to own contracts. Those are actually options contracts. It's a lease contract with the option to buy embedded into the lease. This is also a financial instrument. You can in fact, there also is an OTC market, I've heard, for even options to buy, because you can in fact, when you have a lease to option, or when you have an option to buy, you can sell the option in your lease contract sometimes to other people. Did you guys know that? Yeah, so if you ever in a lease to own options contract with a lease, if the option to buy is at a favorable price, if you get an investor, you can sell him that option for cash, and then he can exercise it and then buy your house for profit if you're planning to leave the house that you're renting. Just kind of throwing some ideas out there. Does everyone understand now the idea of a call option? I'm not going to be able to go into like puts, okay? We can do that another time, but I'm going to explain more because we're already 40 minutes into this. I can explain more about the implementation of it if everyone now understands this. So is there any more questions concerning what the basics of a call option? Okay, I'm assuming everyone is a genius and is retaining knowledge on first hit today. So the numbers that I want you guys to remember from this are the fact that $500 became $1,500. So everyone, I'm going to erase everything, but 500 became 15. Because now, in order to explain the implementation of this, in DeFi, you have to understand the fact that a ledger economy is actually a little bit more restrictive than a conventional finance economy, a conventional instrument economy. So remember, our NVIDIA option it went from 500 to 1,500. So you were able to buy it for 1,500. Sorry, you were able to make triple your money. That's what we're going to say for scenario purposes. If you actually did the math on this, it might be like a slightly higher or lower number. I don't care. Okay, we're doing this for scenario. I'm not doing all that math right now. We would never finish. Okay. So now I'm going to talk about options for Bitcoin. Okay, I'm going to talk about options for Bitcoin, and let's say we would be building this on an EVM chain like Avalanche or Phantom or Binance Smart Chain, okay? So now let's talk about a Bitcoin call, and I'm gonna change the color of my marker. Let me take a look and see if some of these colors are even visible. It is, but it's indistinguishable on the screen. Yeah, this one is, we have way too many of this color here. We can do this one, I think. So now we're going to talk about Bitcoin. Okay, and if we're going to take a look at the price of Bitcoin, let's see. I'm also going to pull some on Yahoo Finance, just because. I can do CoinMarketCap too. Okay, we are waiting for this. Let me get 30 days on here. Okay, so hilariously, Bitcoin was almost the exact same price 30 days ago as it is today. Do you guys see that? It's pretty funny. So Bitcoin was 57,000 about 30 days ago, and it is now again 57,000. Now you can see that in the most recent future days, you'll notice that there was a few red days, meaning it was below the average or below the entry, and then like most of the time in the last 30 days was very green. You can see the emotional state of the crypto market and how it's kind of governed by the sheer gravity of Bitcoin. So let's say you are buying a Bitcoin call, and you're also buying it at the price, the strike of 57,000, right? So we'll call it a strike. 57,000. Yeah, this marker sucks, man. It's something to dry out. Let's see. There you go. Let's say you're going to buy an option for 100 Bitcoin, okay? At $57,000, okay? Now here's the problem, and like here's also why you kind of don't see options being that much of a value add. One, it's because the volatility, the volatility of crypto often kind of fills the need of the degen options trader for that sweet volatility. Like crypto is volatile enough without needing to derive from it. And on top of that, it has to do with calculating the risk of the person issuing the option. Now, everyone remembers, what was this $500 before? What did this $500 represent? Who here can tell me what the $500 represented? And why was that our entry price? Our position price was $500. Why? Does anyone remember? Okay. $500 was the price of the derivative instrument, meaning the option itself. When you were buying the contracts, the stacks of paper, you were buying 500 options to buy NVIDIA at $99, okay? So you were buying shares of NVIDIA. Now, when you exercise this option, depending on the level of financial sophistication of the person issuing the option, they have the ability to just give you the money you're owed. Does that make sense? Like, they don't have to do certain things like actually exercise the option. Does that make sense? Because they don't have to. If you were going to exercise this option, they know that what you're after at the end of the day is just selling the stock. Does that make sense? Like, are you exercising and selling, or are you exercising? Does that make sense? Most of the time, they're exercising and selling. Does that make sense? So a market maker for options in conventional finance, they don't necessarily have to transact 100 shares of NVIDIA. Does that make sense? Because what they have to do now is they have to have NVIDIA stock to sell to you for you to then take and sell back to them. Does everyone understand what I'm saying? So when they buy an option, When you buy an option from Robinhood, Robinhood is not necessarily under the obligation to go and secure those shares for you to exercise. Does that make sense? Do you guys get it? Robinhood can effectively put that into their risk management strategy to say that, like, okay, we're selling so many options, we have so many winners, so many losers. All we want to do, by the way, is first of all, they can penalize exercising and not selling. Does that make sense? So what they can do is they can say, hey, if you exercise and sell, you get the full value. But if you exercise and don't sell, we take 20%. Does that make sense? They don't do, well, I'm not saying they do this, but these are things that are arguably legal in certain OTC markets for whatever reason. Because if you're buying Nvidia at $99, or you're buying a call option of Nvidia at $99, and then you sell it at $120, whoever issued the option for you, effectively, they had to have the Nvidia shares somehow acquirable for you to be able to execute that contract, to exercise it. Does that make sense? Because what has to happen? What has to happen? Here's the sequence. Let me try here. We'll go back to the Nvidia sequence. You buy calls. You exercise. And then we'll say fucking Robinhood. We'll call him Robinhood. Robinhood then has to have / buy 100 times Nvidia. Does that make sense? And then what do they have to do? And then Robinhood also, this is gonna be too low for the screen. Let me see. Okay, you can zoom out. Thank you. We're getting really high production here. Yeah, really high production. I can't wait till I have like a Vanna White assistant to fucking put. Okay, but okay. Robinhood then has to buy 100 Nvidia shares to effectively give to you. Which, by the way, when you bought $500, they did not require you to put that $9,000 up as well. Does that make sense? They did not require you to have $9,900 for the purchase of that. Does that make sense? Like when you bought $500, they didn't take $9,900 from you and held it in custody. Does that make sense? They didn't hold that in escrow. Do you guys get what I'm saying? Because all you were doing was buying the option. Like certain exchanges, because they also manage your account for you, your portfolio is controlled by them as well. So they can effectively just, like a smart contract, exit your position, they can liquidate your positions, and then adjust your balances. In DeFi, we have custodial control of our wallets. I'm hoping this makes sense to everybody. We have custodial control. So unless you give a smart contract approval to do this, it is arguably pretty high risk. And this is another reason that you don't see them implemented, because most people in DeFi do not want to give smart contracts the ability to margin call them. I hope that makes sense, right? Margin calls in DeFi would be viewed almost like you're getting hacked. Does that make sense? A margin call in DeFi would feel like you're getting hacked, because a smart contract is going into your wallet and then deciding what your new balance is going to be. Does that make sense? This is one part of difficulty. So you buy calls and you exercise the calls. Well, then Robinhood then has to have or buy 100 shares of Nvidia to immediately give to you and then pay for them again. Does that make sense? Robinhood then has to buy Nvidia at literally the $120 price, and then effectively just give you the $1,500 that you're owed. They're just gonna have to overpay for Nvidia stock. Does that make sense? And then arguably, they don't even need to hold that Nvidia. Does that make sense? Because they can effectively put that in another risk management portfolio where they're balancing future acquisitions of equities. They can also put equities in a portfolio that is being managed over time, meaning they have a certain amount of stock coming in, a certain amount of stock leaving. Does that make sense? And because all that everybody in conventional finance is trying to do is to get back to the dollar, they don't have to prove to you on a decentralized ledger what they're doing one way or another. All they have to do is get you your $1,500. Are we clear? Does everyone understand that Robinhood is under no obligation to explain to you how they acquired the Nvidia stock, how they were able to let you buy it, and then also you were going to sell it back to them? Does everyone understand what I'm saying here? Has anybody ever seen this on a platform like Robinhood or Schwab or what is it called? Tasty something? I can't remember the name of it. But yeah. Has anyone ever seen this? Has anyone ever seen this in their life where they say, okay, here's what we did to get you your money? Have they ever shown this level of transparency? Okay, so I'm going to explain to you some of the implementations I thought about in building options for DeFi. And I'm going to explain to you why you don't see it executed in the way that I think traders would like. And it has a lot to do with custodial permissions as well as liquidity. Okay, so the first things first, you can't get margin calls in DeFi without giving the approval to a smart contract to do that for you. Now, everyone in DeFi is so risk averse. If even someone as much of a moral paragon as 5 were running an options dex, and I said, hey, don't worry, we're beta testing, but the thing is, you need to give our contracts the approval to margin call you, right? Hey, don't worry. Look, I know that you want to buy 100 shares of Bitcoin. You want to buy 100 Bitcoin for the low price. Sorry, you want to buy a Bitcoin call. You want to buy 100 Bitcoin at $57,000, and I'm going to, this would be what? This would be 57 million? What is, yeah, what's 100 Bitcoin at 57,000? 5.7 million? 5.7 million. This is a $5.7 million position. And I'm going to charge you the premium of 5% of that, right? So 10% is 570,000. So half of that would be like a little under 300K. So we'll call it like 285, right? So we're going to charge you $285,000 for the fucking the price of the option. Does that make sense? So your entry cost is $285,000 for the option to buy 100 Bitcoin at 57,000. So if 100 Bitcoin, they go from 57,000 to what? 67,000. Let's say it goes to 67,000. And by the way, have I lost anybody? Once I start speaking as fast as I'm thinking, or arguably not as fast as I'm thinking, and I feel like I lose everybody because it just blurs together. So if you guys need me to repeat something, I'm not going to be insulted. I'm completely aware that I speak way too fast. Okay? So let's say you get charged $285,000. Now, are you going to let 5 check in your wallet to see if you have the $285,000 necessary to buy the Bitcoin? Because somebody needs to have the somebody needs to have the 5.7 million ready to go. Does that make sense? Whoever is issuing this option, whether it's the issuer, whether that's fucking Pyreswap, or whether that is Maddie, right? Somebody needs to have the 5.7 million ready to go to buy the Bitcoin in the first place. Does that make sense? Because let's say it goes to 57,000 to 67,000, and that goes from 5.7 million to what? 6.7 million? So now there's $1 million, right? $1 million of profit, and you were able to enter for 285,000. So instead of this, let's see, 57,000 to 67,000, that is maybe what, like a little under 20%? Again, maybe an 18% gain. Anybody want to calculate it? We'll just call it 20, right? We'll just call it 20-ish. 20%-ish, right? So instead of that 20,000, instead of this being a 20% gain, buying at 57 and then selling at 67, this $285,000 position is now worth $1 million. So what happens there? This 285 is probably going to go up to $1.7 million. No, sorry. It'll probably go to something like 800 grand. Does that make sense? Let me think. It would actually be this minus the difference. Let's see if that's $1 million. It'd be about maybe 600 grand. We'll just say 700 grand. So this is going to go to 700 grand. So you could turn 285 into 700 grand. And this is, again, very close to NVIDIA going from your NVIDIA call went from 500 to 1500, and now your Bitcoin call went from 285 to 700 grand. Does that make sense? So this is a much larger margin than 20%. Does everyone understand that 285 to 700, much larger margin? You have, in fact, I wouldn't say tripled, or maybe 2.5x. What's that?
It's like 130%.
Yeah, it's like 130% gain. Does that make sense? 130% gain. Does everyone understand that 130 is a bigger number than 20? Because if you guys don't understand that, we're way ahead of ourselves. Okay? Does everybody get it? This is why options are lucrative and they're attractive. But the fact of the matter is, we are in a ledger economy. So when you exercise a call option for Bitcoin, this has to be recorded on the ledger. That doesn't have to be on Bitcoin. It does not have to be on Bitcoin itself. This can be done through wrapped Bitcoin on an EVM chain. Now, making myself clear, we can do this with wrapped Bitcoin or bridged Bitcoin like you have on AVAX. You've got that BTC.B, right? We could do that. this now has to be recorded on that ledger. So first of all, one, we need $5.7 million, or somebody needed to have secured that Bitcoin with $5.7 million before the option was issued. Okay? So the point being here, in real DeFi, by the way, real finance, which is DeFi, you can't fake this. In conventional finance, you can fake it. Does that make sense? In conventional finance, because there is no ledger obligation, the derivatives market is something like it's something like 4 times larger than the global economy. Does that make sense? Because there's no amount of ceiling, there's no limit to how many derivatives they can issue. Does that make sense? If we want to issue Bitcoin options, we are limited by what we have in liquidity at the time. So I'm going to explain how we can implement that. We're going to run out of time, aren't we? Yeah, okay. You know what? I'm going to explain how we're going to implement that next week on the next episode of Theoretics Thursday, because I'm going to explain how possibly we can do this in a later phase of Pyreswap, but it requires a significant amount of underlying regular liquidity that can effectively get restaked into options liquidity. And when it's restaked into options liquidity, that options liquidity is going to get locked up. That's going to be locked liquidity. Does that make sense? For whatever the term of the options we create are. I don't think that we'll be able to create this same vanilla options that you see American and European. We would be able to do closer to European because European's more strict, and American options, they just give you the money. Does that make sense? Like, they just give you what they owe you based on the contract. But in a ledger economy, we would have to record. You buy calls on Bitcoin. You exercise that. Well, somebody is now going to buy 100 Bitcoin because an option was exercised for 100 Bitcoin. This is a significant transaction. It's definitely not a transaction that I think most of my audience has made before, right? At least not at this price. I know guys who were messing around with numbers like this when Bitcoin is much cheaper. But this is effectively the problem. You, in a ledger economy, Route 5 then has to have or buy 100 Bitcoin so that I can deliberately just give it to you at that price and then effectively give you the fucking profit margin where I'm stuck now overpaying for it because I was willing to charge the premium price, the instrument price of $285,000 to let you get into position. So this right here is the structural constraint that limits the growth of derivative instruments on blockchain, like directly on chain, like on chain DeFi. So I hope that this episode of the Pyreswap Show was of direct value to you. There are lots of platforms that are implementing options, but they are in fact, well, Maddie, there are options platforms. DopeX, now known as Strike, GMX, I believe, has options. Pyreswap has convertibility options, and it has yield options, known as the incantation. It has a yield option, known as the incantation. Yes, exactly. Zonic, cash-settled options. Yes. There you go, Pega. Yes. There you go, Pega. Yeah. But the fact of the matter is, Pega, when you put down collateral, does that make sense? When you put down collateral, first of all, you can always remove that collateral. You can always remove that collateral if you don't want to exercise. Does that make sense? But now, Pega, we now have the problem of custodialism in DeFi on chain. Like, that is one way to do it. You create a custodial contract for the option collateral. Does that make sense? At the same time, Pega, I know for a fact you're in Europe, right? So do you trade American options in Europe, or do you trade mostly European options? Yes, exactly, Pega. That is exactly the concern. And Pega, if you heard me say before about margin calls, you're familiar with a margin call, correct? Okay, but you're familiar with a margin call, right? Like on an option, right? So a margin call, if we had to implement that in DeFi, it would be like us doing a smart contract that basically has approvals for other people's wallets to take their money to settle their balance. Does that make sense? So a margin call, if implemented in DeFi, would, I think for most people, get viewed like, first of all, a gigantic exploit vector, and then also they would feel like they got robbed. They would feel like they got hacked. Does that make sense? Because the level of sophistication of the DeFi investor is not nearly where it is. And on Pega, on a conventional exchange, your portfolio is held with the exchange. Does that make sense? Like you have to fund Robinhood with your bank account. Exactly, Pega. Exactly. So I have thought about the way to implement options in DeFi, or what should I say, American and European options. And you need to have a lot of liquidity. Does that make sense? You need to have a lot of liquidity because you can't create synthetic liquidity like Zonic is describing with cash settled options. You can't create this like hypothetical liquidity where you just pay people what they're owed in cash. Does that make sense? In real DeFi, you would have to exercise the purchase of 100 Bitcoin and then literally make that sale as well, and then of course give everybody their cut of it. Does that make sense? So first of all, there's now a gas cost in options. I'm not even gonna get into that, right? And on top of the fact that you're doing this on a chain where other people can front run you. Isn't that crazy? So now the idea that these options are based on these gigantic transactions, you now have the idea that you're gonna spur up this new class of sandwich bots that literally are just there to snipe options getting exercised, which is fucking crazy to think about. Do you guys get what I'm saying? Like, how can Five, the fucking market maker, say, hey, by the way, I appreciate that you exercise an option for Bitcoin on the Binance Smart Chain. Small problem, we got sandwich botted and now it's like 40% less. Yeah. Thank you. Do you guys understand what I'm saying? Like all of these concerns? Because we are in a ledger economy. We are in a ledger market. A ledger-based market changes the way that options have to be implemented. Otherwise, they're not decentralized options. Again, some platforms have implemented this. Dopex, known as Strike now. You have, I think, Pendle. I don't know if Pendle is exactly an options, and I am a fan of Pendle, but I feel like I would do a bad job at explaining it. There is GMX. I believe there's another one called Levels. I don't remember the names of some of these. There are in fact, platforms that are attempting to implement things like options markets. However, they're not real options markets, or should I say, some of them are not options markets. What they are is called bucket shops. And I'm actually going to talk about what a bucket shop is, and then we're going to wrap it today, okay? So let's talk about what a bucket shop is. Okay, all right, and we are on screen, and can everyone see the screen? Let me just get some verification that I'm not missing any questions. Can everyone see the screen? And if you are looking for this link on Wikipedia, you can just Google the word stock market bucket shop, and this will be something that pops up. So a bucket shop is a business that allows gambling based on the prices of stocks or commodities. A 1906 U.S. Supreme Court ruling defined a bucket shop as an establishment nominally for the transaction of a stock exchange business or business of similar character, but really for the registration of bets or wagers, usually for small amounts, on the rise or fall of the prices of stocks, grain, oil, etc., there being no transfer or delivery of the stock or commodities nominally dealt in. Does that make sense? A person who engages in the practice is referred to as a bucketeer, and the practice is sometimes referred to as bucketeering. Bucket shops are found in many large American cities, but the practice was eventually ruled illegal and largely disappeared by the 1920s. Okay, so a bucket shop, when you make this bet, this is also a derivative, but it has no relationship to the underlying. So a lot of options platforms, they are not transacting in the underlying. They are just using oracles because they're using price references to determine the value of an option. I'm hoping this makes sense. They're using a more complicated I'm going to call these like shadow options, but really more like synthetic options. A bucket shop is a synthetic options platform, effectively. And again, bucketeering is illegal according to the Supreme Court of the United States. And there are DeFi projects that are arguably could be considered they are engaging in bucketeering. What's interesting, though, is that financial regulations have created so many loopholes around the idea of a bucket shop that now majority platforms, since all they have to prove is that they have the liquidity to exercise. They can kind of circumvent the accusation of bucketeering because they can just prove that they have reserves. Does that make sense? So you can use proof of reserves to arguably deflect the allegation that you're engaging in bucketeering. But if you don't have any reserves, if you're just engaging in the buying and selling of the option and you just settle it in cash, you are engaging in bucket shopping, which again is considered illegal through a first world country's legal framework. So if you don't have the underlying liquidity, you are engaging in bucket shopping, which is another, it creates another security risk. Does that make sense? And then additionally, what is actually causing the liquidity, the underlying liquidity that you're getting cash settled in to be replenished? Does that make sense? Ideally, when you're kind of building an options market, you would create a incentive for the counterparty. Does that make sense? You have to issue a call option and a put option, and they both have to have a significant depth of liquidity. Does that make sense? They can even be in liquidity against each other as far as like the constant product formula goes. But this creates a bunch of the dominating narrative in DeFi right now, which by the way is not literate, is something called fragmented liquidity versus concentrated liquidity. Does that make sense? And in order to actually issue options effectively, and I guess you could say canonically, you would need to fragment liquidity more, because you would need to reserve chunks of liquidity for use in options. This, by the way, is a great way to actually continue to use liquidity, and I don't know why certain people haven't approached this way. I certainly know I will in future phases of Pyreswap and other things that the circus builds. But right now, because so many people that are builders in DeFi are absolute fucktards, they believe that they need to concentrate all their liquidity. And if they're concentrating their liquidity, they don't have an ability to create reserve liquidity that is intended for options trading or for the exercise of options. Indeed. I'm not going to comment on that last comment, but yes. I hope you guys understand. So for things like margin calls or things like obligations like futures, you would need to have a smart contract approve what they could take out of your wallet, or you would need to provide collateral for the entry, which is kind of crazy, if that makes sense, because most people who want to trade options do not want to prove that collateral, or they would prefer to kind of circumvent that. And sometimes they can give you a percentage of collateral. And I know that a friend of mine engages in a business model where he gets to trade with another platform's money, and he gets a share of that. And there's so many ways to configure these things in finance. They're very, very interesting. But I hope that we have at least highlighted today some of the theoretical and implementation problems when it comes to the execution of options in decentralized finance. I want to thank everybody for coming to the Pyreswap show. Tomorrow we are at a different time. Tomorrow we will be 6 hours later in the day. And tomorrow or over the weekend, we will be announcing the schedule changes for the Pyreswap show to be implemented next week. So if no one else has any questions, I will do my salute. Thank you guys so much for coming. Have a great rest of your day.